we hear debt ceiling negotiations. I think everybody wants to know. I've been following this negotiations for the entire, last 2 weeks. I've been like reading. So now we have two credit rating agencies placing the US AAA status on rating watch negative. Last report I actually explained to you already. The first was Fitch, now the DBRS. The previous downgrade was way back in 2011, and we saw a major sell-off in the S&P 500 in the proximity of 20% when these rating agencies downgraded US AAA rating. Okay, and due to the way the US economy is structured together with the dollar currency, it will certainly cause ripple in the outside markets, whether you like it or not. We are very, very tied to this US market. Now, having said that, a deal will certainly come to fruition, which I've really repeated again and again. And today already, they have already announced that they have come to agreement. Because on Friday, this Yellen, that's the change there. Okay, Janet Yellen. Okay, there. Okay, Janet Yellen, right? The U.S. Treasury Secretary on Friday issued a statement that they have. She has changed a new deadline. Okay, she set the new deadline from the original June 1st deadline, and she wrote that the next one would be June the 5th. Okay, so she said she now estimates Treasury will have insufficient resources to satisfy the government's obligation if Congress has not raised or suspend the debt limit by June the 5th. That's next week, not this week. So that in effect will give a lot of time, number one, for them to go and write up this bill and then to pass it next week. Okay, so the developments here, we have seen first, the weekend reports are showing that US debt ceiling appears to overcome an impasse already. That means so far it's okay. They are close to finding a resolution, because at the end of the day, it's only 70 billion apart. What the Republicans and the Democrats, the disagreement is 70 billion apart, and it's about spending. So this it's a minor gap. That's why they're going to believe this. That's why this morning report came out whereby both parties have come to an agreement. So that's a good thing, right? That's also the reason why you see the Asian market is up, Bitcoin is up, because this whenever risk, all right, whenever risk drops, those risk-off asset classes, they will just shoot up. Okay, so now the key point is this. Now, is to see if both parties are able to sell what they compromise upon to the party members. This is crucial, because they were appointed by their parties to negotiate. Okay, Kevin McCarthy represents the lower house, right? So now he has to go back to the Republicans and say, look here, this is what I compromise upon. I think this is a good thing. So it's about selling it back to them. Whether they agree or not is a different case, right? And the Democrats, they appointed the White House to negotiate. So basically, the White House represents the Democrats. Now it's Biden going back to the rest of the Democrats and to sell it to them. It's not going to be easy, because during the weekend, we saw some Republicans as well as the Democrats, right? They were actually saying that they are unhappy with certain things of the negotiations. Now, this is not a good sign, so don't celebrate as yet. But anyway, just to let you know some statistics, right? So if the debt ceiling is raised, right, usually what you see is the S&P 500 rising between 3 to 6% after they announced this thing. They said, okay. But don't forget, immediately you're going to see the US dollars being printed. Okay. Immediately you will see that they're going to print more US dollars. So more supply of US dollars is going to come in, because that ceiling is very. is being lifted. That's the main thing is going to happen behind. More US dollars is going to be thrown into the market, and more supply. You know what's going to happen to the price, right? So that we want to see the progress first. What's going to happen? Now, the risk here is that I don't want people to celebrate too early until the both parties sign on the dotted line, agreeing on this and voted, and it passes through. Because what's going to happen is that you see this scenario can happen where both sides do not have enough votes to push through the bill due to insufficient support arising from a slim majority. The Republicans have a very slim majority in the House, and the Democrats have an extremely slim majority in the Senate. So for a bill to pass through, it must first go through the House, and then it moves to the upper house, which is the Senate, and then only this bill pass, and then Biden signs it. Now, because if you look at the number of Republicans and the Democrats, right, they are so close. If I'm not wrong, I can't recall, okay, there's so many numbers, I didn't check on this one, but we are looking like just 1-2% difference, I think, in the lower house. And then I know for sure that for the Senate it's just one vote the difference, and that's Kamala Harris, having her vote counted as 2. So it is a very slim majority. And if you have, like I said, if you have either one side, what you call the hardliners, right? They said, I don't agree, that this is just too much. No, they do not vote for this. This whole thing can collapse. Okay. So like I said, don't be too happy, because I think they need time to draft it. Today is holiday, they may be drafting it, and then probably on Wednesday they bring it for passing and everything. So the earliest, I think, it will be next week to get all things done, right? So like I said, this is good news so far for the market, but whether it's going to pull through, both sides have to sell, and they're going to sell really, really hard, because both careers, are on the line, Kevin McCarthy's as well as Biden's. Now, next part I want to talk about negative view is, I don't want to sound negative too much, but I think it's also good to let people know what is really happening in the market, right? Now, we have a negative view for quite some time already, and to be exact, it's 11 months. Now, traditionally, negative yield is used as an indicator of recession. Now, from the chart, we see that we can see 1980, 1990, 2000, 2008, negative yield were preceded by, not negative yield, sorry, the recession were preceded by yield curve inversions. Okay, now these are all the recessions. All these gray areas are the recessions. And every time before we hit the recession, you can see the market goes into negative yield territory. So this is actually one of the indicators of a recession. It doesn't mean 100% of the time, but it is what we call, I think only one time only it did not happen. We had negative view and the market didn't go into recession, right? So look over here. That means this indicator here has a very, very, very high accuracy. And the US has been in a negative yield since July 2022. And that's 11 months since it first happened, and the longest since the 1980s already. Okay, that's why going forward after this, you might hear the recession coming in, especially if the Fed pushes up its interest rates again. Okay, so this is something that I really want to warn everybody. Just be careful. Don't be too happy, the hoorah. It is based on personal experience and datas. Okay, datas. I'm collecting datas to view the probabilities, because I've already said again and again, I mean, I don't understand how can an economy keep on going up and going up with high interest rates. You know, there will come to a point where people think it's just too expensive, right? And things starts to change. Now, if you look at the negative view, it's typically driven by investors who are concerned about the economies since World War, not World War 22, World War 2. My God. Yeah, this is we're only going to have 2 World Wars, not 3, okay? So I don't want to be guy who says World War 22. Now, every economic recession has been preceded by a yield curve inversion, okay, since World War 2. The fact that going forward, okay, banks would be tightening their credit adds to the fear of recession. So that's the thing. I'm looking at the facts that's thrown inside over here. We have high interest rates, number one. We're going to have banks tightening. It's not me saying it. It is the Fed acknowledging it, okay? And then you have a negative view. You have all these things. I don't know. I just don't see how can economy go up just if things don't change. Now, according to statistics, when the US yield first moved into negative territory, the US market first makes newer high. Only after 6 to 22 months over there, then you can see over here, these are the time taken before the yield curve turn negative and then turn into a recession, okay? 6 to 22 months, then you see the market coming down. Now, if we use 18 as a guideline, you know, in between them, 18 over here, we don't go to the maximum, we could take the second one. We have 11 months before this recession can happen, and that would be pushing it to 2024. Okay, so we shall see. We shall see the developments right over here. The longer the Fed, you know, Fed has already said they want to maintain the rates, and we have seen the stats which I shared with you. Usually Feds, how long would they hold the interest rates once they have stopped increasing their rates? But we thought that the Fed probably would be, you know, the June 14 FOMC meeting, they would not be hiking the rates. But let's look at the probability, because when I saw that, it was a great surprise to me. Why I say that? Now, look over here before we move into that part, right? That suspense part, what's the market probability? I just want to let you know one thing. If in the last 5 recessions, right? I took the last 5 ones, okay? We have the COVID, the Great Recession of 2007, 2009. Then we had dot-com bubble, the Asian financial crisis, and the early 1990s recession. Now, all this time, the recessions dropped 34, 56, 49, 19, 20. I think I've shared this with you in past in the chart form, right? So look over here. These are the probability market can drop by so much right over here. So any chance of the market moving into a recession right now will depend on how the Fed react. Okay, now looking into the probability analysis, this is a real surprise to me. Now, first of all, if you look at the PCE and the previous CPI data, the month-to-month one, we saw a slight increment on the month-to-month inflation. And the release of the Fed minutes saw the Fed rate hike probability change. You know, it changed. I was surprised. I'm like, oh my. Now this, in turn, is going to make the June 14 meeting a very important one. Why? Now, because the market is not expecting the Fed to hike its rate by another 25 basis points. 1 week ago, only 1 week ago before the FOMC meeting, we had only the chance of a Fed rate hike at 17.4%. Now, it went up as high as 64.2%. Now, in previous reports, I already mentioned, right, we hit 70, that's the likeliest it would be the final outcome already. We are only 5.8% away to hitting the 70% mark. Of course, this is still too early to say, but we will see this when the June 14 draws nearer. And that's the reason why this June 14 is going to be an important, very, very important one. If the Fed continue to raise rates by 25 basis points, on that day, I believe we're going to see a red day in the US stock market. Okay? It is crazy. That is my personal observation, my thoughts right on that. Okay? So it's not good, keep on raising and raising and raising and raising.